Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul. And good morning and welcome to all of our viewers and our listeners out there. Welcome back. It's Tuesday, and if it's Tuesday, we're talking real estate. Thanks again for tuning in to everyone out there. And for those of you who have not tuned in and have not watched us, you're really missing the boat, and you won't know the difference until you do. So next time, join us as we talk real estate and other things. I'm excited about today's show. I am Barry Saywitz, president of the Saywitz Company and managing partner of Barry Saywitz Properties. And today's show, we're going to do a little different spin on things. And I'm going to do a little bit of talking and a little bit of conveying some of the feedback and input that has been given to me over the past several weeks and months about what to do with your money, right? I get asked the question all the time. You're having lunch, you're at the dinner table, and people say, well, what am I supposed to do with my money? It's inflation, I got a war, I got high gas prices, I got a volatile stock market, I got a shaky real estate market. What am I supposed to do? And the answer is give it to me. But if you're not, if you're not excited to do that, we're going to try and give you some thoughts and suggestions as to the pluses and the minuses of different strategies. And while I am no ultimate expert and I do not have a crystal ball, you got to try and make best use of the information that you have and the things that are going on around you. And that's what we're going to try and do today. So, Paul, I think the way we've got this set up is you're going to fire off some questions, and
I'm going to ask the tough questions and see if you've got real answers or if it's all just maybe.
Are these true or false, and do I need a number 2 pencil, or
yes.
I can just make stuff up as we go?
I think you can make stuff. I don't see why you should be any different than anybody else today. Every other prognosticator on television or in the media seems to be making stuff up these days.
Right, and I'm going to go with the politicians and everything else. On the one hand, it's all good. Everything's good. Yeah. We're all good. And then if you're of a different school of thought, it's all terrible and it's doomsday. And so somewhere in the middle, right, I think, is the truth.
Or it can be both at the same time here.
On the same day, sure.
On the same day. Well, that's really what this show is all about. We've done shows in the past with viewer questions, very specific questions. I'm thinking of doing this. I'm wondering about this. Very short term. This is our chance to look big term here. What most people in your industry either say they can't do or don't want to do. I listen to your guests who come in the show, and you kind of push them to get real. But after it's over, they're all like, well, of course, I have no idea where it's going. I really don't know. And we've never seen anything like this. Is that where we're at? Are we at some black swan special time? Is this a once-in-a-lifetime experience, or is this just a continuation of the bumpy ride we've been on for 10 years, COVID, 9/11, all these things that just keep shocking everybody here?
Well, again, the question is, am I thinking long-term? Am I thinking short-term? Am I thinking opportunistically, or am I thinking pessimistically?
Right. Offensively or defensively.
Exactly. And so, that's really part of the answer is you've got to build your strategy around whatever your goals and objectives are, not around what you hear on the news or what you see on the internet or what somebody else tells you they're doing. And so we'll try and help. We'll try and offer up some insights and inputs today, and hopefully people have some good takeaways from it. So I wish we had a mirror here so that I could see myself as opposed to just talking into the wall. I'm going to try and do my best to
talk to the audience.
I'm going to talk to the audience.
This is your chance to be on stage and give your thoughts and opinions here, right or wrong. And of course, we're going to come back a year from now and see if you were good at guessing or not here.
Yeah, and this is radio and podcasting at its best because it's actually video, and so we're going to give it a go. All right, with all of that said, welcome to the show. Let's get going. Fire at me, and I'm ready.
Only 3 places people can historically put money, those that have it. I can put it into the stock market, or bonds, stocks, whatever, some other asset, and speculate if that's going to go up or down. Or I can put it into real estate here in Southern California and speculate whether that's going to go up or down. Or I can just sit on the sidelines and hold it as cash. Where are people putting their money today?
Yeah, and again, let's talk short-term and long-term. And again, it's not for everybody. It depends on your strategy. But there's no question that the stock market in today's world, highly volatile, high swings up and low. I mean, for me as an investor, I certainly would like to see my stock portfolio continue to rise, but I'm good with small increases and small decreases. These giant swings, if you rewind back to the 80s, if you had a 500 or 1,000 point swing in the market, you would have the entire economy crashing. You would have people jumping off of buildings. And yet this happens every day, right? And so, one day it's up 500, the next day it's down 500, and there's
or 1,000 or whatever.
There's no rhyme or reason. It's because the markets look to the future, and because you cannot see the future, you have high volatility in terms of what's going on. And as a day trader, I mean, I don't even know how you do it, right? That's just high stress, and you can make a ton or you can lose it all in the same breath. And so, look, if you want to put your money in the stock market and you're in it for the long haul and the market is down, then you have to ask yourself, is it going to go down further? Is now the time to go in? Everybody I've talked to, and I'm not the expert, says that's just not a smart play at the moment. You are better off with the wait and see to see if the market's going to dip some more and get some more consistency to the news that is coming out that may impact or stabilize the market. Now, with that said, if you're not going to put your money in the stock market, what if it's already there? What do I do with that piece of it? Right? And so for that piece of it, again, if you're in it for the short term and you sell, you can take a tax loss and you could go right back in or put it into something else. But you could pull out of the stocks that you're in or the funds that you're in and put it into something else that you think has a better chance of increasing in the future, but no one's got a crystal ball there. You could pull it out and put it into bonds. You could put it into real estate. You could stick it in the bank, but then you may have missed the upswing, depending upon when and if that happens. I mean, eventually it will come back. So again, short-term, long-term, really difficult. I don't see a lot of people pulling their money out of the stock market to go invest in real estate. And the reason being is because whatever they're pulling out of the stock market is less than what they had yesterday or last week or last month. So people feel like, hey, I just don't have as much. And so you don't see that flood. And then the real estate is not necessarily the safe haven. While it is more stable than the stock market at the moment, there's still risk and they're still unknown. So the pull out of the money or the put the money is, hey, now you can get 3% in the bank and rising. And so I can buy bonds, I can put my money in CDs, I can put my money in the bank short term. Long term, that is not a good strategy. That you have to make alternative investments to be able to get a better return. But in the short term, you don't see this flock to real estate. The volume of real estate in the third quarter of 2022 and the fourth quarter of 2022 is going to be dramatically less than it has been in the past, and that is going to impact what happens with pricing and cap rates and everything else. That's my general take. I mean, certainly you have to look at the individual deal and the individual submarkets, but in a general sense, it's slowing down. It's already slowed down. You've seen it.
That amazes me because I thought with the turbulence in the market, people would be pulling out, take their losses, and try and make it up somewhere else, maybe in real estate, because that seems to be going up dramatically and the stock market's going down.
Well, and again, it's a different strategy for everyone, but you have other people that have owned real estate for a while and also own stocks. And then those people are saying, hey, I can still sell my real estate while it's high and offset the losses I've taken in the market because I'm watching my retirement or my portfolio dwindle. And so I maybe need cash, want to feel more secure. Don't know. Real estate's illiquid, right? A declining stock value of your portfolio, while it's liquid, it's just not helping your cause to bail out. We haven't seen the widespread selling in the sense that the average person is out there just bailing out in a dead panic. I think everybody is waiting to see what happens, and I think a lot's going to tell here in the next few months, and see what happens on the politics side, what happens with the elections, what
if the Fed keeps going up,
if the Fed keeps going up, if there is a control on recession or not, and if it affects people's spending habits. So there's just, I mean, look, I'm not the prognosticator, but there's a lot of factors out there that could keep you up at night if you let it. I think you have to pick a short-term strategy at the moment and then maybe meld that into a longer-term strategy. But unfortunately, because you can't see long-term out there, you can only deal with the shorter-term decision-making.
Where's the institutional money going these days? I don't know. In fact, we've never talked about this offhand. I don't know if you seek outside investors and run REITs, or if this is all just your own money and your own stuff as you buy and sell properties here. But I wonder where the institutional money's going, because there was a phase where they were intrigued by REITs or property or even dirt, and farmland and other sorts of things.
Yeah, again, I think it's on a case-by-case basis, but you do have all of these institutional funds that have some percentage in real estate. And as the stock market becomes more volatile, maybe they increase the percentage in real estate because it's a little more stable. But they're out there. They're just looking at bigger deals, and they're not looking at double-digit returns. They're looking at reasonable returns. And so it's different than the mom and pop or the everyday investor. It's really two schools of thought. You don't see the smaller to middle-sized guy competing against the larger institutional guys for deals, and you don't have the same mindset or the same goals and objectives. So they're out there, and they have money, and they're sitting, and I think that they're being very careful at the moment about what deals they go into instead of just rushing in, because I do think that the perception is that tomorrow's deal will be a little bit better than today's deal in terms of pricing or cap rate.
So is there a large amount of cash sitting on the sidelines ready to go either back into stocks or real estate or some new alternative,
there
crypto
is,
or something?
yeah,
I don't know, whatever.
Again, there is and there isn't. On the institutional side, I think there is. On the average daily investor side, here's the problem. The problem is if you have a stock portfolio and you were borrowing against it, or you were relying on the premise that I am rich because I have a bunch of stock,
Right.
and now your stock is down 30%, you're not as rich as you were, and you're not feeling it, and you're not feeling warm and fuzzy to go spend the money, and you can't borrow against your stock portfolio as much as you could. You can't get a home equity line. I mean, you can. It's just you're going to go home get a home equity line at a really significant premium. For some elderly investors who had reverse mortgages,
Right.
they could borrow against the reverse mortgage and used to be able to borrow at 4 or 5%, and that number's now like 8%. And so you better be getting 10% to offset the risk associated with borrowing at 8. And where are you going to get a 10% return? And the answer is not unless you're taking a lot of risk. And so you're now mortgaging your house, which is no risk, which is your safety net, against a deal that's got quite a bit of risk in a volatile market. It's really just a horrible strategy, I think. And so the question then is there is less money out there because people are not running around spending it. The flipper, right? The guy who says, I want to buy a house, I'm going to fix it up, I'm going to put some lipstick on it, I'm going to paint it, I'm going to put some new countertops in, and then I'm going to sell it and make a bunch of money and go on and do the next. That was a career. I mean, that was a one-off thing that turned into a career for people, that turned into an investment strategy.
Turned into TV shows.
Sure. and so... So, and this is nothing new. It's been going on for a long time, but it became very popular, and you had a lot of people jumping on the bandwagon. That is over. Right? That is over unless that really is your business of what you do. Because the guy who does it on Sundays, the guy who does it on the side, number one, the profit's not there. Number two, the costs to build it and do the renovation are through the roof. Number three, I have supply chain delays. I have the fact that I cannot get vendors to do the work so easy because everybody's busy. There's so many reasons why that strategy for investment is just gotten whacked, for lack of a better term. And so now all those people are on the sideline. And so then what do they do with their money? They're sitting and waiting because they're not putting it in the stock market. And so some of those people were looking at buying small apartment buildings or small office buildings.
Right. That's my next question here.
And so, again, now the interest rates are up. So now I get squeezed on my return. And because the interest rates are up, the loan to value from the bank is small. It is less, which means I get a smaller loan. So I'll pick a number. If I was buying a property for $1 million, and I used to be able to get a 65% loan to value, I would get a loan for $650,000, and maybe that building needed $50,000 worth of fix up to spruce it up. If you buy an older building that needs a bunch of work, that $50,000 could be well over $100,000 in today's market. And then my loan to value could be at 50 or 55% and not 65%. So what does that mean to the investor? Instead of coming up with $350,000 to buy it and then $50,000 to fix it up, that's $400,000. You're now coming up with $450,000 and $100,000 to fix it up. Now it's $550,000. And so it takes
that's real cash you got to take out of your
and it takes people
bank
out of the market, and you've got to get a return on it. A lot of people have bought over the past cycle of the real estate market investment property under the premise that, especially here in Southern California and Orange County in particular, I buy it, it's always going to go up. I bought my house and it's worth 4 times what I paid for it. I'm a real estate expert. I bought a rental home and it was worth X and it's now worth 2X, and I'm a hero. I'm going to do it again, right? Nobody thinks back when that house is worth, 70% of X or 60% of X, or that the rent doesn't cover the mortgage, right? And so if you're not making deals based on cash flow and you're not getting a cash flow return on your money, a return on your investment, then you have to be pretty darn sure that you're going to buy it and you're going to fix it up and you're going to flip it in some reasonable period of time to get your return, and you have to be okay with no cash flow.
Or you can hold it long enough until the cash flow appears.
I guess. But if someone, again, depending upon what you're trying to do with your money, if you're interested in cash flow, because stocks typically do not have cash flow, and the ones that have dividends probably not paying so much or less than they used to. So if I'm looking for cash flow in my real estate, make your decision making based on the income against the expenses. Don't make it based on the value of the property. If you're looking to flip, or you're looking short term, or you have no cash flow and you want to buy a property and you think it'll be worth more later on, then don't be surprised when you don't have any cash flow.
Give us a quick primer on the one term you guys all banty about, you all understand, and we all struggle to understand: cap rates. That's what you're all basing this on, and you keep saying cap rates are an all-time low these days.
Yes. Well, so cap rate is the return on the investment without any debt on the property, for those people out there who are not familiar with it. And basically, when you look at the investment return, if the cap rate is, pick a number, 4%, that means I'm getting 4% on my money. So if I bought that property for $1 million, whatever it is, then I'd be getting 4% or $40,000 a year in return after my expenses, including the income without the mortgage. Now, the problem is, if I buy a property at a 4% cap rate and then I go get a loan at 6%, I've now hurt myself in my overall return. And so my 4% cap rate is probably 3%. And then on top of that, if I have expenses because the property needs maintenance, or I have to do fix up, and I factor all of that in, my return could be well less than that. And in many instances here in Southern California, you see deals that have a 0% or a 1% return. And so that dog doesn't hunt unless you're doing significant improvements, raising the value of the property, raising the rents, and then adding value. And then you don't care about the current cap rate. You only care about the future cap rate. But the problem is, if you buy it based on a 4 cap and you think you're going to sell it based on a 4 cap, and then all of a sudden the cap rates go to 6, the value of your property comes down, right? This is a little real estate 101 stuff. Right. But the issue is, are you doing it in the short term? Are you doing it in the long term? And the guys who are buying it in the short term, looking to hold it for 3 to 5 years, tough to pencil deals today because it's volatile and it's moving, and tough to get investors to invest because they're not sure if the numbers you're giving them are going to hold. So it really makes it a little dicey. And with all of that said, I would just say in the last several weeks, I've seen more deals fall out of escrow, come back on the market, calls from brokers saying, hey, could you buy this property? And my guy's willing to drop the price if you can close quick. Why? Because we get back to this concept of certainty of close.
Yeah.
Because if you make a deal with someone and you're not sure if they can close, or it's predicated on an appraisal, or it's predicated on getting a loan at a certain rate at a certain number, the market's moving. And so by the time you make the deal and the time you go to close, what happens? The interest rates go up. The Fed raises the rates. What is a natural knee-jerk reaction? Natural knee-jerk reaction is buyer comes back and says, I need a better deal.
Right.
And it's what we call
or I'm pulling out.
Yeah, it's what we call in the industry the retrade, right? So there are different tacks of how to do the retrade, how to explain the retrade, why I need the retrade. Some are legitimate, some are just I'm haggling. The fact of the matter is, in a downward trending market, you're going to get the retrade, and for whatever reason there winds up being. And if there's no reason, it's just because I think the economy is getting worse, and I don't think you have anybody behind me. And so the seller's in a difficult spot, and so what winds up happening is I either do the retrade, or I tell the guy, forget it, I put the property back on the market, and then the next guy might do the same thing to me. And so if you're a broker out there, you know what I'm talking about, and it's a difficult market of trying to balance and manage expectations. At the same time, we're back to the same issue, which if the property was overpriced in the first place, and then you have to drop the price, it's not the end of the world. You were at some ridiculously high number, But now
You're still up.
you're still up and you just got to get out. But other people are trying to hold on to the last dollar and stubborn about it. And I think a lot of those people are going to be sorry that they took that strategy.
I had the privilege of watching on a panel at Genesis Bank a while ago, commercial real estate a panel, bunch of prestigious players, brokers,
I think I was
owners.
on that panel.
That's what I'm saying. I watched you on that panel here, and you said something that I thought would send shockwaves, and it didn't even cause a ripple. They just sort of heard it and went on. You said that your strategy, and I've never heard anybody say this, is I'm buying cash right now. Now, I might cut a deal for that cash, but you get certainty of close, and then you go back and maybe
Right, but-
refinance or something.
Yeah.
Talk about that. I thought that was like, wow, everybody go, really? There's a different idea. Everybody's like,
But
what?
not everybody can do that, right? I
Right.
mean, well-heeled investment companies can do that. Wealthy individuals can do that. REITs and institutional guys can do that. The average investor who needs a loan on the property cannot do that. And the problem with the cash strategy in today's environment is I buy it for cash. I could still do that, and then as can others, but it's still certainty of close. But I now have to go fix it up. You've just sold me a piece of junk, right? You've sold me a value add property. Maybe it's not a piece of junk, but it needs work. It needs help, and I have to go do the value add. My problem is I can't pencil an interest rate for when I get the property stabilized because I don't know where rates will be. So I will have to estimate, and I have to estimate that number to be higher because that's the indication where we're going to be. And so I have to factor that into my model. I also have to factor that you have increased prices. So we used to put in apartments wood flooring. That's like the trend these days. Nobody puts carpet in, and so we put the wood flooring in. It used to cost, for a 2-bedroom apartment, it used to cost about $3,000 to put the wood flooring in, whereas the carpet might cost half of that. And today, that same $3,000 is $5,000. So I mean, it's not like it went up $50 or $100. It went up like 50%. No different than the refrigerator that used to be $800 that's now $1,200. Right? I could go down the list.
Multiply by the doors, as you call it, the number of units you've got.
So I now have increased construction cost. I have delays because of supply chain. I have increased rising interest rates at the end of the day. And all of that has to go back into my number. And so is it a good use of your cash, whether you're paying all cash or part cash, to go do that with the uncertainty? And therein lies the question. And so if I'm buying it at yesterday's dollar minus some moderate discount, is that still enough? And I guess we'll see how that goes.
The great Warren Buffett once said, you never know who's naked until the tide comes out. Are there going to be a lot of naked property owners when the tide comes out?
I think I was sick that day when he said that. But I think that there's people that overpaid, that bought at the top of the market, that are not well heeled. And those people in a tight landlord market for renting industrial space or apartments or medical space, or even before the pandemic retail space, you could just hold up your hand and you didn't have to be an expert to rent your place out and keep it filled. As you go forward into recession, people are struggling, businesses are struggling, and that is the common theme where people come back for a bite at the apple or people need a deal. And if you're not equipped to be able to handle that, or you're not smart enough to navigate through that, you're going to have some issues. And those are the people that the savvy investors want to talk to, because they're going to be the ones that are selling just to get out. We're not there yet. We're definitely, I don't want to be doom and gloom, but the fact of the matter is I think that the interest rates are going to continue to rise. It's going to continue to put downward pressure on property values. And where that downward pressure takes us, I guess, remains to be seen.
Well, I'm old enough to remember the 80s when the Japanese, suddenly flush with cash, came fleeing over here and buying landmark properties, hotels, high-rise office buildings, everything, and ended up so much of that taking a loss on it here.
Almost all of those guys took losses, heavy losses. The difference, though, I think if you look at the Japanese of what happened in the 80s and the early 90s against what's happened with mostly the Chinese or even the Middle Eastern investors here in Southern California in particular, they like it here. They like the environment, the dynamics, the weather, what have you.
Right.
They're trying to get money out of their own country. They're trying to get money into something other than whatever they were doing at home, whether that's oil, whether that's manufacturing, so that their government can't get access to it and they can put it into something else.
And in some cases, they don't care if they make anything just to get it out.
Correct. So different mentality than the Japanese, who just had a very strong economy that were looking for returns. And then all of a sudden the return went away. and they needed to bail out. I don't think you're going to see those types of investors that brought foreign money and that paid cash to hide it or get it out or whatever you want to call it, bailing out. I think they're parking it and then they're just going to leave it. And so it'll be interesting. I also don't think that you see the kind of influx of that kind of foreign money gobbling up properties so much left and right. And then secondly, I don't think that you see those types of investors buying B and C type product. They want the prime product. They want to buy a house in Newport Coast. They want to buy a trophy type of an asset or something in Central Park or what have you. They're not buying the B and C stuff.
But was it the Montage? Something just came on the market here. I forgot. One of the big premier properties here in Orange County. And I don't know which one it is. And I wondered, again, if that's that money, it was foreign owned. I'm wondering if that money is bailing out or if it's just trying to take advantage of the height in the market, they think.
Yeah, it'll be interesting to see. And then the question is, who buys it? Is it somebody else with foreign money who's doing the same thing that's in a different position? Or is it somebody who's actually going to pencil it based on some logic of the analysis, right? So when you apply logic to real estate investment, you're looking back to, again, this return on investment. And if it's not there, you have to adjust the price versus I'm buying on emotion or I'm just parking the money or I have some other alternative. This is no different of a concept than the 1031 exchange.
Yes,
if
right, you talked about that
if I
too,
sold a property and then I sold it for a bunch of money and I go, geez, that was a ridiculous amount of money. I just made all this money. I don't care if I buy another property and I overpay. It's not that big of a deal because the last guy who bought my property, he overpaid even more. Mm-hmm. I talked to a friend of mine on Friday, and we were talking about apartment building, and he said, I bought this apartment building down for the street from one of yours. And I said, yeah, no, I know that. He says, yeah. I said, when did you buy it? He said, about a year ago. I said, oh, I remember that. It came on the market. It was very expensive. He said, yeah, we overpaid. I mean, he just admitted it. And so I said, well, why'd you overpay? He said, we were in an exchange. Somebody overpaid for our property, gave us a number we couldn't refuse. We didn't really care. Now, the good news is he bought it a year ago and the market still went up. And so he said to me, I haven't made any money in a year, but I think long term it'll be a good hold. But I did overpay, but it didn't matter because it was negated by the fact that some other guy overpaid even more.
And I didn't have to pay the taxes.
I didn't have to pay the tax. So again, that motivation is totally different than, call it me walking in the door going, gee, this deal has to pencil or I'm not going to buy it.
Right.
And so as the exchange activity in the market goes down, the volume goes down. As the volume goes down, you have less bidders on a particular piece of property, in which case you only have maybe one or two real buyers, and then you have price adjustments. You just do.
Well, let's leave it there. Some look ahead. Give us, well, actually, before you end, so give us the 60-second, the two-word answer: up or down, good or bad. What's next year look like?
I would just say, if you're not sure what to do with the money, you can call us.
You'll handle that for us.
We'll help you spend it. I like shopping and eating. But I would say that there is no single up or down. There is no single good or bad. You're going to have to look at the different pieces of the economy and try and navigate through the fog, if you will,
right,
to try and make the best decisions that you can. And I don't know that there's a perfect one in this environment. Hopefully you just don't make a bad one and end up even worse. And so I'm back to the same comments that I've made on many other shows, which is get yourself professional help, whether it's a financial advisor, stockbroker, real estate broker. Don't read the back of the cereal box. Don't play on your phone and see what came up on the news feed and then react to that based on that information. That is not what's going on in the real.
But isn't that what everybody's doing these days?
Well, that's the problem. And that's candidly, if you ask me what keeps me up at night, is it's the public perception of what is going on in the market, not the dynamics of the actual market itself. If people perceive the market's going to tank, if people perceive that gas is going to continue to go up, what do? They go to the pump and fill up, right? Yeah. And so if they think the market's going to go down, then they start hitting people below the belt on the offers. They start not bidding on stuff, and it just is a self-fulfilling prophecy. I think we'll know more as we go into the first part of the year, based on what the trends are going to be.
So maybe some clarity after the first of the year.
I think right now it's pretty tough, right? You got a lot of people on hold. You got a lot of people wondering what's going to happen, and there's still just a lot of moving pieces out there. So all the more reason for our viewers and our listeners out there to keep tuning in as we bring in more expert in different aspects and dynamics and pieces of the marketplace to help you get information that you need to make those kinds of decisions. So I am Barry Saywitz, president of the Saywitz Company. Thanks again for tuning in and listening in. And we'll see you back here next week talking more real estate. Thanks again.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.